when we all met last May, right, I have to tell you that we were quite nervous about all the service providers being ready in time for the launch. And we spent large part of last 9 months working with the service provider. And we're really thankful that everybody who spoke on the panel today says they're ready or they're about to launch. So we want to thank them again. And it was it was very important that they were ready. Now, over the last 2-3 months, there have been a lot of questions on the indexes, right? People have said, hey, this is how I've been looking at things. How should I look at things into the future? How the indexes are going to change as the launch of UMBS happens. So what we thought we'll do, we'll get a team of index providers who would kind of walk us through as to how they're thinking of the indexes once the UMBS goes live in June. So I would like to invite the team of index providers. Yeah, okay. So meanwhile, I'll maybe spend a few minutes introducing the next panel. We're going to be joined by a team of 4, on this topic. First, we'll have Nick Genedron from Bloomberg. He's head of global fixed income for index products with Bloomberg. Nick is based out of New York and manages the fixed income benchmark index product team at the Bloomberg. Nick has been with this business, index business, since 1992, so which is over 25 years. And he was with Lehman Brothers initially, then subsequently with Barclays. In his current role, his responsibility includes new product development, research, ETF pipeline, and more importantly, marketing support for the entire suite of fixed income index products. The second panelist would be Nikki Stefanli from FTSE Russell. She's a managing director of global fixed income policy there with the FTSE Russell. Nikki, currently, in her role, she's responsible for methodology for all the fixed income benchmarks. Prior to joining FTSE, Nikki led benchmark research and development effort with US Barclays index business. The third panelist for us would be today Preston Peacock. He's a senior research data analyst with ICE. And he works for the data indices business within ICE, and he has over 2 decades of experience in bond indices. In his role, Preston frequently advises institutional investors on a wide range of benchmark selection and performance measure issues, and routinely assists clients in creating their own custom indices. The last panelist in this would be Preetham Nanda. He's from Global Index Research, JP Morgan. So he's the executive director with JP Morgan's index research team. He's also a product manager responsible for strategy, development, and marketing of JP Morgan's global fixed income rates and securitized indices. So if you have questions on indices, this team should be able to answer all of them before, in this panel. Thank you.
Thanks, Ravi. Okay, I'm on here. So there's no moderator for this panel, so I think I'm just going to kick it off. I think the format really is for each of us here to give about a 5-minute update on how we're handling the UMBS initiative at our respective index firms. So I'm very happy to be here with Nikki and Preston and Preetham. My name is Nick Gendron. I manage the index, the fixed income index side for Bloomberg, came over from Barclays 2.5 years ago to Bloomberg. So last time we were all at a UMBS conference, which was about maybe midway through last year. A few of us here were talking about how we were in this large client consultation period about UMBS. On the Bloomberg side, we certainly continued that into the latter part of last year, and finally in January ultimately made an announcement in January about exactly how our index business was going to handle the UMBS initiative. So before I get to the details of that exact announcement, I think it's important to kind of set the stage. What does our index look like currently? I'll take just a couple minutes on that. So the index right now, most of you probably know, but you take hundreds of thousands of pools that are out there and really aggregate those up into generic securities or cohorts. They're broken down currently by Fannie, Freddie, Ginnie, and then by coupon, and then origination year. So altogether, you get about 300 securities or so, maybe just over that. So again, and then we're pricing each generic out separately, actually pricing all the pools underneath each generic security and rolling that up as to the price of each cohort and calculating returns and analytics on each of those securities. So that's how the index is set up today. So how are we handling UMBS? So if we look at UMBS, what we've decided to do, and really Jackie from Bloomberg alluded to this before, we are actually going to be creating a brand new set of Freddie 55-day generic securities, about 100 of them or so. We discussed a lot of different options with our clients, and this is the decision we came to was to keep the granularity for Fannie and for Freddie and for Ginnie as far as the security level detail of the index was concerned. So again, what you're going to be left with is separate cohorts for Fannies, a new set of cohorts for Freddie 55-day. You'll have the current Freddie 45-day securities, and then you'll have the Ginnies as well. So again, we're adding about 100 or so cohorts to the index. And the new Freddie 55-day securities will actually just keep taking balances from the Freddie 45 days as they start exchanging into mirrored pools. Those balances will go into the Freddie 55-day securities. And of course, any new issuance as well of Freddies will go into the 55-day as well. So we'll be winding down the 45-day. That'll be going into the 55-day. As far as sort of index inclusion criteria, what we're doing on our side is we're looking at the outstanding amount of both the Freddie 45-day and the Freddie 55-day security and adding those together to determine if the 1 billion threshold is met. So we're not going to be dropping any securities if they fall below. If one of the two falls below $1 billion, but the combination is over $1 billion, then both will stay in the index. So that's how we're going to be handling that. Let's see. The last thing that I do want to mention is there's certainly going to be clients who want to look at UMBS combined. If we so to take a look at how we'll be handling that, we'll be creating a new field called UMBS, which we'll be adding to each of the cohorts. So we'll turn that on, switch on, if you will, for the Fannies and for the Freddie 55 days. And obviously for the Freddie 45 days, it will be turned off. So that will allow any user of our analytics or file feeds or what have you to aggregate at the UMBS level as opposed to looking at things separately between Fannie and Freddie. So it just gives an option for clients, and we can create sub-indices based on that as well. We'll be looking at creating UMBS sub-indices at different coupons, different origination years. And again, just as with everything, we think this is an appropriate first step into this UMBS initiative. Certainly you could have made the argument right off the bat to combine the securities together, but that's not how we're going to handle the first phase of this, and certainly open to that discussion as the UMBS initiative evolves. So I'm going to now hand it over to Nikki. Those are my comments, and certainly happy to take questions.
Great, thanks, Nick. And thank you to Freddie Mac and Fannie Mae for having us today, and for all of your help in kind of helping us prepare our clients in the market for this initiative. I think Nick was right to level set kind of this exercise with just kind of a few words about how mortgage benchmarks are constructed. The benchmark that I'm here to speak about is the FTSE Mortgage Index, which was acquired from Citi back in 2017. So it's constructed, I think, similar to the manner in which everyone's mortgage indices are constructed. So it aggregates thousands and thousands of underlying pools into what's called a cohort or generic, and then that generic will show an aggregated balance and also a price that's used to represent the underlying pools. Another point that's just worth mentioning in terms of how mortgage indices work is their rebalancing mechanics. So the indices kind of have their balances updated for pay downs and new issuance once a month, and that reflects everything that happened as of the prior month end as a cutoff. So if you envision how the rebalancing will work through single security, you'll have everything that happened in June kind of cut off at the end of June, those balances being reflected for preview or statistics purposes, and then that being reflected in your August universe for purposes of return calculation. So there's a degree of a lag from a benchmark standpoint in terms of what go live means, so that that's something that I've been kind of trying to highlight to folks as we've been talking about the implications of this on our benchmarks in particular. So just a few points to touch on. I think similar to kind of what Nick said, we've been deeply engaged with the market and with various market participants, pricing providers, folks on research desks, to kind of come to a landing on what we think is the most, I think, appropriate approach initially. So that is to say a similar kind of scenario where you have kind of continuity with Fannie. So you have your Fannie securities and cohorts that exist pre-go live, and then that looks the same post-go live. For Freddie, you'll have your legacy Freddie 45-day PCs that have the same kind of ticker, have the same kind of continuity in terms of what they look like, and then we'll introduce a new set of cohorts for Freddie UMBS that will kind of come into the index once their balances reach an appropriate threshold. So that is at its earliest probably for returns purposes, not until August. In terms of other technical details, I think we've been clear, I think, from the onset that the exchange compensation is not something that will be incorporated into index returns. So that is, I think something that would be almost comparable to a transaction cost, which is not typical, or a reverse transaction cost, which is not typically incorporated in a benchmark return. I think customers generally can kind of appreciate that from a benchmark standpoint. And then maybe just a few words on where we go from here after go live. So I think one of the main impetuses of why we chose to take the approach that we did, which is to have 3 cohort buckets, is to make sure that we can accurately price the market and reflect the economic realities of the investors who are benchmarked to our products. So by preserving more granularity at the cohort level, you can accurately, I think, try and pinpoint any pricing differences that may arise. Hopefully, that kind of through a transition period, I think all kind of settles a bit, and then at that time, we'll probably go through a similar process to, I think, take stock with our customers around whether some sort of consolidation or some other kind of change might make sense at that time, and then give appropriate notice and do all of those things that prudent governance requires of us. So just in terms of other more, I think operational considerations that I just wanted to highlight. So in terms of the cohort level changes that users can expect, we mentioned that there will be a new Freddie UMBS cohort that will just look like a new line item in the index. So there won't be a ton of change that's noticeable at the cohort level. Those new cohorts will likely just have a different ticker so that they're identifiable as Freddie UMBS. We also think it's really important that we provide tools that provide a view of the new world. So we'll do that with updated sector level reporting, with new kind of market structure breakdowns for, in our parlance, index profiles. So we'll give all of those consolidated views in addition to maintaining granularity at the cohort level. And then also kind of off to one side, we'll run consolidated cohorts for UMBS. So, folks can see that, as well as consolidated Freddie views. So that will be available kind of to folks who want to see the world at the cohort level through that new unified view. And I think that was it from my side. So I'll hand over to Preston.
Okay. Great, thanks, Nikki. And I will also say thanks to Nick for laying out kind of how we all go about constructing our indices. And it is something that is standard in our industry. So what we all do is aggregate pools to generic cohorts and then price those cohorts, and that's how we run our index. So let's take a quick look at what the new index landscape's going to look like with UMBS. And there's nothing shocking here. This looks like a mess, but it really is not that different than what you're familiar with. Now, if you imagine another box kind of off the slide for Ginnie Mae, then this is the entire index. You have Fannie Mae collateral aggregated, you have Freddie Mac collateral aggregated, and of course Ginnie as well. Now, underneath each of those boxes is, of course, various coupon and production year cohorts, as we call them, which in turn is the aggregation of all of those underlying pools. Now, in the center section, you see the new issue Freddie UMBS. That's what we're all getting excited about. It's going to happen in June. But you're going to have a relatively slow start there from the index perspective, because that takes some time for those new issue kind of pools to get aggregated into a cohort that's going to meet the size criteria. We have a 250 million cohort criteria for inclusion in our index, and it's a 5 billion minimum per coupon. So it's going to take a little bit of time to meet that 250 million criteria there. Now, one of the things to be aware of is that you also have the exchanged mirror pools that are also going to continue to exist. And that's the other box there in the center of the screen. Now, those two things can be thought of as one thing, obviously. So the same issuer, both have the same payment delay, and that is the Freddie Mac UMBS world. Now, one of the interesting things to realize here is that legacy Freddie Mac Gold PC is going to be around for a long time. So we've been focusing on two things, the new UMBS, and we've been focusing on the exchange process, but 70% of the collateral from Freddie Mac Gold PC is not exchangeable. All right, think about that for a second. Those cohorts are going to continue to exist in the index for a very long time. And the Freddie Mac UMBS at the start is going to be a relatively small component of the index. So that is, I think, an interesting point to consider when you look at some of the options that we as index providers had to think about to figure out, well, what is the best thing for us to do? Being index providers, we are trying to capture the market. What is the market? The market is all of the index qualifying collateral. That is not going to change. It is, however, changing form slightly. One of the things that we were talking to our customers about, our stakeholders, through this long consultation process, and we got started probably talking or trying to talk to clients before they even wanted to talk about it. I got far enough along in thinking about what does it mean for their day-to-day portfolio management process and risk, their understanding of how they were going to trade the market. So one of the things that we kept hearing is that, well, we don't believe that this is really an index issue. And which made perfect sense because, again, the index is just tracking the market. The market is not changing. It is changing form. At least a small part of it is changing form and how it's represented. And I think that's a key point. As an index provider, I'd like to make sure that you appreciate. So Fannie Mae reflected in the index. Obviously, that's not going to change. Now, Freddie Mac collateral, we have a couple of options as index providers. Yes, the overall total collateral is not changing, but there is a portion of it that is going to change its payment delay and will be exchanged. So one of the key things I think we had to struggle with is, do we commingle? You've heard that word a few times probably today. Commingling can be, I think in this context, two things. Commingling Fannie Mae and Freddie Mac collateral into one cohort, not an idea that appealed to most stakeholders that we spoke to. And that does not mean that they ultimately think that this will not be a successful initiative, but that they believe that the issuers are separate and that they need to manage their portfolio to have an understanding of what allocation exists and also to track performance and I think relative value. So that right off the bat, I think one of the key decisions was, are you going to commingle Freddie Mac and Fannie Mae into this new UMBS universe? The answer to that, based on all the stakeholders we talked to, is no, we would not like you to do that. We would like to be able to do that on our own, but we would like the ability to split it out. So, and that's something I think you've heard from the other index providers present on this panel. We're kind of, you can see there's variations on a theme here. We're all hearing the same feedback because we're all pretty much doing the same thing and talking to the same investor base. That's not surprising. So the Freddie Mac gold pools that are not exchangeable are going to continue to be are going to remain in their existing legacy cohorts. So there's no change there. So that portion of the index will continue to exist. And as I mentioned, it's the overwhelming majority of the Freddie Mac share of the index, and it will continue for a long time. Now the question becomes, how do you handle these mirror pools that are exchangeable? And I think that's a much more interesting question because you have the option to kind of slowly exchange these things and kind of switch them over, if you will, to new cohorts that will be UMBS. And those would slowly start to grow. Now, how slowly, we don't know. But you could look at the reported amounts that have been exchanged, and then when we get to our rebalancing, you make those changes. As Nikki mentioned, there is no return impact on this. This is just a change that happens to the basket, at the index at the rebalancing itself. So the amount would be reduced on one side and increased on the other. What we heard was that our stakeholders were not particularly interested in this messy, slow, drip-by-drip process of going through the exchanges, that a big bang, assume it's done and get it over with, was the preferred option. Simply because, again, there is no return impact. Structurally, you understand what it is that this is going from one bucket to the next. And there is a 10-day difference that we can easily quantify, and we understand what that means. So again, no impact on the collateral represented in the index. Your questions really as an index provider are, how do you represent this new world? And our decision on the exchange process was keep it simple. That was a recurring theme in the telephone conversations that I've been hearing for months. So our choice was to just simply exchange at the May 31 rebalancing, which is the month in which the exchange process gets underway and just before the first Freddie Mac UMBS is issued. That's all I have. I'll turn it over to Preetham.
Thanks, Preston. Good afternoon, everyone. So when I was speaking to Mark from Freddie at the conference earlier last week, he talked about the countdown clock, but I'm looking in front of me and there's a countdown clock between lunch and me, so I'm keeping that in mind right now. So I think a lot of what everyone has said pretty much holds true. I think there is a market consensus when it comes to indices. It's minimal interference, reflection of the market. But maybe I'll just sort of quickly, quickly talk about our index, the agency index, which is we call MAX. I think that Nikki made a really good point about the timing lag from an index standpoint, where yes, all of this go live is end of May or early June, but there is a little bit of a delay. And so those are the considerations we've been really sort of taking into account when we're deciding how we're going to reflect the new cohorts. So effectively, from an index standpoint, we've had this index relatively recently compared to many of our other indices that have ran for decades, if you will. It's a research-led index. Matt Joseph and the strategy team have had it for many, many years. And what we've done is we've institutionalized this to be able to have better transparency. And it's the same outlook that we try to bring for a single security initiative. I think the first one comes down to the amount outstanding. We have a 500 million cutoff, but I think the important thing here is that when you're thinking about the 45 days getting transferred into the 55-day, the new labeling, if you will, we didn't want to dissect the two into different notionals. We wanted to incorporate that as one, so that you don't have an artificial sort of drop in one and an increase in the other side of it, so that the index continues to be complete. So the main themes that we tried to keep in mind was completeness and stability of the index composition, the transparency in which all this has occurred, and the broadest market coverage that we could have. Right now, the index represents a little under 6 trillion in terms of all of the eligible securities. So we have between the enterprises, the 15-year, 30-year, as well as more recently the 20-year has been added. So we'll continue to approach it that way, where we'll have the 500 million notional as a sum of both. Now, after that, the other consideration is, of course, about the 10-day float. From an index standpoint, this shouldn't impact any returns, and I believe the market feels the same way in clients that we spoke to, and as well as other researchers, and I think you've heard from the other panelists, that you don't want to artificially impact the total return. The way we thought about this is if you take total return and you break it down between its, say, 3 core components, which is the price component, the coupon interest, and the pay down of principal, you could argue, well, when you look at when a 45 exchange occurs, you effectively have a lowering of its total outstanding and gets brought into the 55. Well, from the back end, and because this is an exchange and this is an artifact of an exchange and not truly a pay down of principal, you don't want that pay down, you don't want that exchange to be seen as a pay down to incorporate it into the returns. Similarly, the exchange compensation is effectively how we thought about it the same way. From an index construction point of view, we actually bring in 2 other groups as part of JP Morgan. One is our third-party pricing provider, Pricing Direct, who independently price at the pool level, as well as our Bond Studio team, which are the mortgage analytics platform, which are effectively able to give us CUSIP level granularity. And what this allows us to do is be able to aggregate up and provide the full breakouts for the legacy gold, the new 55-day. So you have a line item for each. You have existing Fannie, as you've heard the other panelists talk about. And of course, you have a new tagging that will start with UMBS. So what this allows you to do is have different cuts of the index, so that anybody who's looking at continuing to track it doesn't all of a sudden on day one see this massive change, and they wonder, how do I stratify all of this data that all of a sudden has shifted. From a go live perspective, we are pretty much closely in touch with other consumers of our data as well, so that they're beginning to imbibe some of the data, whether it's your Aladdins or your other risk attribution platforms that anyone might use. They continue to have the same level of stratification with new naming conventions, so that it's very clear that you have the 45s, 55s, the UMBS, and that the stratification can continue to occur. And finally, in terms of the continuity of the index, one of the features that we've been able to offer due to Pricing Direct and Bond Studio as part of our sort of larger index initiatives are to be able to update factors by the 6th business day. And we believe we'll continue to be able to do that The pricers will continue to price the 45 days. We'll continue to receive the CUSIP level data for all of the pool level of factors that we need to apply, and including the look-ahead file, the preview of the statistics, if you will, that will come out a few days prior to rebalance day. And like everyone else here, we're going to aggregate all of them throughout the month, but only reflect them at the rebalance date so that you don't have this artificial notional change, whether it's due to amount of standing changes, or it's due to exchanges, or it's due to any non-index, non-true market-related events. So there's about 3 minutes left. I believe I covered everything. Maybe I'll open it up for questions. Over there. I think you might need a microphone if you want to hang on one moment.
Thank you. Hi, this is a question for probably all of you, but so I just want to make sure I'm understanding this correctly. So for one of the, sorry, I'm like trying to find the, so did you say that you're going to be putting all of the exchangeable mirrors into the index, into the Freddie cohort all at once? Everything that's exchangeable would go in there all at once? Is that right?
No,
Did I understand that? Sorry, that was a question for, yes, for Preston, sorry.
Yes, I thought, okay, yes.
Yeah. And then I had a question for all of you. So that's different than what the other,
Right.
Okay.
Correct.
So just wanted
Yes. So yeah, there's about 30% of the current Freddie Mac Gold PC collateral that is actually exchangeable. The rest is not. So
Right.
we will plan to do that switch at one point. So you at the end of May, you have these new cohorts that will be introduced in the index. That's correct.
Okay, and then for JP, ICE, and so all of the others are going to go gradually into the cohorts,
Yeah,
and that'll only happen once a month. Is that correct?
Yeah, that's
Yeah.
what we're doing. We're again, we'll put the generics into the index, and their balances will just continue to get updated as the pools are exchanged.
Okay, thank you.
Okay, well, is there anything else? I'm sure we'll all be happy to hang out here for a bit if you want to come up and ask anything else. Other than that, thanks everybody. Guys, it was good to talk with you, and have a great lunch.